Welcome to the Tax Pro Show. I am glad you're here. I'm Josh, the CEO of Nat Business Solutions, an EA with over 20 years in tax. I'd like to take a few minutes to talk about year-end tax planning. We are getting to that time of the year where, well, quite frankly, the countdown is on. We only have a few days left, and so at the end of each year, there's always a number of things that you should consider that could very likely have a positive impact on your tax situation. I've got a list of things that I'm going to go over. They're pretty basic. Maybe some of this applies to you and you want to take advantage of making these changes. One thing to note is this year we've got some recent law changes with the OBBB, and so I'm going to talk about how that could also impact you. I've got 10 different things that we're going to cover, so let's jump right into them. Number one, I'm going to tell you, we want to maximize your retirement savings, potentially while reducing your taxable income. There's still time to make contributions to that employer retirement plan, like your 401k. And remember, each year has a contribution limit. And if you don't take advantage of it, it's gone. With law changes, it's very important to note a couple of things this year. So, special bonus catch-up contributions for those that are age 60 to 63 is $11,250, and that's up from $7,500. So you could leverage that rule if it applies to you. And then also a new change, beginning in 2026, those with incomes above $125,000 can only put catch-up contributions into the Roth employer retirement accounts. So plan accordingly next year. Like I said, with the 401k, it's a use it or lose it. Make sure you're maximizing it. And I would tell you, you always want to put the money into the Roth first. So get that matched, then go Roth. If you haven't maxed out this year, you still have a few days, get it done. Number two, leverage the new $40,000 tax limit for those itemized deductions. This one is huge. We've been capped, the SALT tax cap of $10,000, and it's been impacting lots and lots of clients. You can now pay those property taxes this year, and there's a huge chance that you're going to get to take more than that $10,000 depending on your income limit. So make sure that you're going ahead and paying that tax before the end of the year to take advantage of that. Number three, fund any final charitable donations, right? Remember, your strategy here may change with the new law, and it probably will, okay? And that will include the ability to deduct more. So make sure you're reviewing potentially donating appreciated stock that's owned 1 year or longer, either directly to a qualified charity or through a donor-advised charitable trust. If you're 70 and a half or older, consider making a qualified charitable donation, a QCD, from a qualified retirement account, okay? There are some limits that apply to that, so be aware of those and make sure that you're doing what you need to. If you're not sure on that QCD, you can reach out. We're happy to help you. That brings us to number four. You're going to review your investment portfolio for any kind of capital gains and any kind of losses and plan accordingly. If you've got some gains, you may want to harvest some losses to offset those gains if you know that there's no likelihood for those losses to be used or those losses to be overcome. In other words, the company's bankrupt and you know the stock's worthless, sell it, and we can use those losses to offset some of those capital gains. Of course, you are limited to a $3,000 loss limit on those net capital losses that can offset ordinary income. But I'm always surprised, right? When I go look at my portfolio and what's sitting in my brokerage account, if I've got something that's just I'm never gonna get that stock to be profitable, go ahead and harvest that loss against other gain. Number five, maximize the Kiddie tax threshold and gift rules. Remember, $2,700 of unearned income can be taxed at your child's lower tax rate. And you can gift up to $19,000 per tax year per kid this year. You can gift that, and then also, like, potentially if you're married, your wife could gift that, or you could gift that to a grandkid. So think about how we can maximize those thresholds to avoid kiddie tax. Number 6, review medical funding accounts. Remember, contributions to an HSA or a health savings account, if you have that available, can lower your taxable income. Not only that, any unused balances carry over year to year. And you can even invest that account and the gains are not taxable. So maximize that. Also, you want to look at your annual contributions while there's still time with regard to MSAs, medical savings accounts. They don't have the same flexibility, so it's good to review the rules and make sure that you take advantage of any plan available. You might need to, spend money out of that MSA if the funds aren't rolling over, or whatever you need to do to ensure that you're taking advantage of the tax-free funding opportunity with those accounts. Number 7, prepare now for tax-free tips and overtime pay. If you've not already done so, review the approved occupations for those qualified tips and confirm the amounts of the benefit long before you receive documentation from your employer. You should know. Don't put it on your employer to have them know. You should know. And you should have an idea before the end of the year of what overtime or tips might not be subject to tax for 2025. Okay? The employers are not required to issue W-2s or 1099s with a breakout in 25. So it's up to you. You've got to know. That brings us to number 8. Estimate your tax liability and make any final estimated tax payments. Remember, tax-free tips and overtime are going to impact that. There's a new $6,000 senior deduction, $12,000 for you and potentially your spouse. Also, current tax withholdings. If need be, make any adjustments. Any other impacts that the new laws might have, like interest paid on new car loans potentially, and how that changes your situation. If you don't have a good tax plan, you still have some time to make necessary adjustments. And number 9, consider any rollover of tax-deferred retirement accounts into Roths. So if you've got something that's tax-deferred, you're wanting to get that money into a Roth, maybe this is the time that you can do that and you can save some money on your taxes. Number 10, get prepared for tax filing. This includes creating a list of expected W-2s and 1099s if you had multiple job changes. Again, reviewing those tax withholdings, issuing any required tax forms if you've got household employees or that kind of thing, and organize those tax records. I've already got a folder for charitable contributions that I'm already receiving statements on. I'm already saving those and setting those aside for my taxes. If you've got any questions regarding any of these 10 things, or you need some help and you're not sure where to turn, reach out. My team is happy to help with your tax issues. You can go to our website, tax.pro, and fill out our contact form. My team is ready to jump in and help you any way we can to maximize your dollars and make sure that you're operating tax efficient. I'm Josh with tax.pro. Don't forget to like and subscribe to our channel. I look forward to seeing you on the next one.